go ahead and get started. So if everyone can find your seats, please. Appreciate that very much. And for those of you who may not know who I am, my name is Sherry Heine. I'm the president and CEO of the Prescott Chamber of Commerce. And I'm your semi-MC this afternoon. And I'll be making some brief remarks. And then we're going to go ahead and get started with the program. And I always like to start our events with a quote. And so I did some big study today for this one. So here we go. A well-functioning financial system is essential for an economic stability. How about that for the topic of today? That kind of gets us in the moment here. This is a working lunch, so we would appreciate if everyone maybe turn off your phones. Let's be in the moment. Let's focus on our speakers today. We have some really great content for all of you, so just want to make sure that we're focused here for the meeting. I also want to thank Miss Ashley Perkins with Modern Coffee for catering our lunch today. Let's give her a round of applause. I do want to recognize some dignitaries that are in the room today. We have our council member or councilwoman, Mayor Pro Tem Connie Cantelmi, Miss Connie. And we also have councilwoman from Prescott Valley, Miss Lucy. And I know she's right there. You are. Thank you. Also, it's my honor. I feel very privileged for this because I do believe this could be his first event. I know it's his third day on the job, but we want to have a warm welcome to our new city manager, Dalen Kimball. And Tyler Goodman, we want to thank you. We know you've stepped in. You've been our interim. We appreciate you. We also have some friends of ours from Prescott Valley. We have Cutter and Diane from the PV Economic Development team. Hi, guys. And my very good friend, colleague, partner in crime sometimes, Miss Marnie Ewell from the Prescott Valley Chamber. Thank you. Love you. We also have board members here. I want to recognize Megan Smith, our incoming chair. Hi. Jillian was supposed to be here, but her daughter is graduating from kindergarten today. So I feel that she gets that pass. So we also have our foundation board members here, Miss Darla DeVille, our chair. Darla, everybody knows Miss Aloha. And also Mr. Sanford Cohen. Sanford? And I know Lenora, did she step in? She was planning to be here, but I haven't seen her yet, but she's with Bennett Oil. I also want to recognize our ambassadors that are in the room. Our ambassadors are a strong group for us. We really appreciate you. They support everything we do, and we have a lot going on, so we're going to be keeping them pretty busy. So thank you, ambassadors. I also want to really thank our staff, our team, Miss Crystal, who put this event together. Also, we have Marie in the back, our business development, Miss Katie, who keeps me in order, Miss Glossia, who is our accounting manager, and of course, we always leave Robert at the ranch so he can take care of business. So thank you, team. Awesome. We appreciate everything that you do. And also, if there's any Prescott area young professionals in the house, I always like to recognize all of you as well. Yay. Thank you. Just for the record, that's the 40 and under group. So we should all be raising our hand for that. I also have just, I just can't say enough about this event. We were kind of reminiscing. This is our third event here. We've really appreciate 1AZ and the partnership and bringing this program, but we also want to really thank Yavapai College for being a co-host here. And we really appreciate all that you do. And I know the college team is here in the SBDC. If you guys want to be recognized, all of you, just kind of raise your hands, and we so appreciate all the support that you provide for us. And I have the honor to introduce Vincent Redgrave, with the Executive Director for Industry and Innovation, and you're going to share a few remarks for us, please.
Hi, it's still good morning. Great to be here. Wonderful turnout, the who's who of Yavapai County and a few folks from beyond. So this is marvelous. Sherry, thank you for the kind introduction. Real big shout out to Sherry, the Chamber of Commerce of Prescott, 1AZ Wealth Management. Thank you to these guys for putting this on today. So round of applause to you guys. Thank you. I'm glad Sherry called out the SBDC and the REDC, my team. Who I will call the hardest working people in Yavapai County. You might disagree, that's okay. But I have to do that because I do their presence. Wonderful team, getting some great things done. So what does that mean, SBDC, REDC? Well, for those of you who know our beautiful SBDC team, taking entrepreneurs and getting them through that whole, an idea in somebody's garage to, getting that business plan together, getting the right type of funding, and then taking that business and getting that off the ground and then seeing that expand. So not just with new business, but also with incumbent business. So very, very important to what we're doing in Yavapai County in terms of economic development. Then alongside that, the REDC is sort of, I guess you might say, filling in some of the gaps. So real heavy with regional collaboration, business to business organizations who can help those businesses, and then circling that back into Yavapai College. And through Yavapai College, for those of you who don't know, we just, in the last couple of weeks, graduated 1,750 students in almost 2,000 disciplines, right? It was a long afternoon watching all those people go by in caps and gowns, but it was fabulous, right? Because that is our talent pipeline for all the businesses and wannabe businesses that we have here in the county, right? So that's good news for everybody. And then in tandem, the REDC is also working with incumbent businesses in terms of training. So that could be senior leadership team, executive leadership, management, upcoming leaders. We provide all that. We also provide data and economic analysis and evaluation so that we can make smart decisions and keep our economy moving and ticking over. And then also, you should all have one of these. I'm going to shamelessly plug this now. Please take a look at this. Get this out to everybody you know, whether that's in your business, your organization, the Quest grant. We have free training. It's very rare we have this opportunity. And the REDC and SBDC have worked very hard to get this opportunity for us and for our community. So if it's something you can't use personally, give it to your aunt, uncle, cousins, nieces, nephews, your workforce. Everybody needs to get on this while we have it. So please, because this is a great opportunity and a free opportunity to upskill our workforce and our potential workforce. So thank you. All right, without further ado, I'm going to put you into the hands of the real experts. I'd like to introduce Chip Griffith from 1AZ Wealth Management. Chip, over to you. Thank you, everybody.
Thank you, Vince. And can you guys hear me? I know I'm a little height challenged here, so I'm going to have to move the mic here a little bit. But good morning, everyone. Good afternoon. Thank you again. My name is Chip Griffith, Senior Vice President with 1AZ Credit Union. Just to give you a little bit of insight of the credit union for those that aren't aware, we've been around a little over 70 years. So we've been in the Prescott area as well as throughout the state of Arizona for a good amount of time, for decades and decades. And we did start as a segment focused on our state and local government, and that is now since grown to everyone who lives, works, or worships in the state of Arizona is eligible for membership. So a big deal for us, and we're very, very vital in the communities like Prescott, and love that the Prescott Chamber is here and hosting this event. Thank you. This has been one of our favorites every single year. I know I've attended it 3 times. We'll continue to attend it. Also, you think about why there's such a great attendance in an election year. People want to know what's going on with the economy. Is that crazy? So I'm really looking forward to what Chad has to speak of. But again, we've got 20 branches here in the state of Arizona. definitely committed to the growth, to the education, to the wellness of the communities, to the individuals, and how we can drive that forward and continue to grow and prosper as a state of Arizona. So that's really a big deal, and we're happy to be a part of it on days like this. Obviously, we've got our branch team here, our business banking team here, our wealth management team here. So we've got a lot of representatives. And of course, some are actually running the business today. So we are open for business. So we've got a lot out in the field as well. So thank you again for coming here today. Great turnout. Appreciate everything. Yavapai College, thank you. Great facility. I know, just looking back, I've been here a number of times for volleyball tournaments. And again, there's a great opportunity to upskill through trades, through college here, through universities, and love seeing the facilities like this and being a part of it. So thanks everybody for joining. Next up, I want to introduce our leader and our head of our wealth management department that makes all of this happen. So Tom Mitchell here is going to take us the rest of the way and lead us on.
Great.
Tom.
Thank you. Wow, I think everybody's been thanked. Is there anybody not thanked yet? Okay, I want to make sure I do say thank you to you. If not, I want to shake your hand. Thank you, Chip. My name's Tom Mitchell. I have the pleasure of being the leader and manager of the 1AZ Wealth Management Program within the 1AZ Credit Union. Now, Chip said the credit union's been around how many years? 70 years. The 1AZ Wealth Management Program has been around 20 years. 20 years. If you look there at our logo, underneath wealth management, it says what? Investments, insurance, and retirement planning. We recognized at 1AZ Credit Union there was a need for our members and our communities to be educated and helped in the areas of investments, insurance, and retirement planning. Hence, 1AZ Wealth Management was created and has been thriving for the last 20 years. We're happy to say we've just crossed over $500 million in assets, and we have over 5,000 clients. So we are very, very well seated and successful. We're excited for that growth to continue. And the reason it continues is because we believe in something. And what we believe in is an educated person is a better person, and is a person that we can know that they'll be better off tomorrow than they were today. And we're going to give them that counsel and that advice. We've always taken a fiduciary stance. What's a fiduciary? Someone who does right by you and is always thinking what's in your best interest. So we actually have a whole flight of advisors. We've got 7. I'll be hiring an 8th advisor here very shortly. I have 2 advisors here today. I'll just ask them to raise their hands. Tori Jewett. Here's Tori. He's up here in Prescott. And in the back is Bob Nichols. Bob, where's your hand? There you go. They're here to field any individual questions that you have. One of the newer initiatives, 2 years ago, we recognized a real strong need for businesses and their need for education, their need for counsel and investment and insurance services. So we really put an effort in that direction. And one of the things that we make available now is something called a biz equity analysis. I might have mentioned it last year, but I'm making it very clear. I'm mentioning it now because it is in full swing. It's called biz equity analysis. If you are a business owner, you must want to talk to us because we have a system and a tool. We will gather some information about you and your business, and this biz equity analysis will actually do a overview market valuation and give you a market value of your business. Now, it's not a certified appraisal, but I'll tell you what, it's pretty darn close. It's very accurate. It gives you a lot of great information about your business and how you can improve your business. We've seen businesses use it and actually take some of the direction and advice that it creates and actually improve the value of their business. One case in point was about $1 million valuation. And about a year and a half later, the business is worth $3 million. Simply by engaging and utilizing some of the recommendations in that analysis tool. It's about 24 pages long. It's a great report. Now, what does that report cost? Well, we're very pleased to say at 1AZ, we're making this report available and this analysis to be done on a complimentary basis to our businesses because we believe in the importance of education, and we believe in improving people's lives. So without further ado, let me talk about we want to improve your life today. We're going to talk about the 2024 mid-year market outlook. We're happy to be here. This is our third year. Thank you for making that call. It was exciting to be here the first year, better last year, even better this year because I have a full room here. Yesterday, we were in Sedona conducting it for the first time. Today, we're here for the third time, and tomorrow we'll be in Cottonwood doing it for the second time. So we've created a huge, nice tour of the northern region of Arizona now, so we're excited to be here. So without further ado, I want to introduce our speaker. Our speaker today comes from Washington Crossing Advisors. He was a co-founder of Washington Crossing Advisors out of New Jersey. He has about 30 years experience. He doesn't have much gray hair. How do you pull that off? All right. No, seriously, Chad Morganlander has a nice, strong background in the financial services industry. Started his career in 1992 with Lehman Brothers. Some of you might remember that name. Then he went on to work for Gruntel & Company and also Ryan Beck & Company. And then he founded the Washington Crossing Advisors. And he'll have some sharing comments about how he started that as a small business owner with his co-founder and how hard it was getting it started. But today, he's quite successful because they run two portfolios, and those two portfolios have about over $10 billion now in assets. Very, very strong, very successful. I like their money management style, and I think at the end, during the Q&A, we'll get into the details of that. We'll talk more about that. We're able to bring someone like Chad to this group because of our affiliation with LPL Financial, and I do want to make that call out. LPL Financial is a registered broker-dealer, independent broker-dealer, that we are affiliated with here at 1AZ Wealth Management, and that allows us the opportunity to pull from all different sources and channels when it comes to investment advice and investment research. So about a year ago, I was at a conference and I was having a conversation with Chad. We were, I think, in California. And I was mentioning the successful events that we've been conducting here. And he asked, hey, can I come? And I said, sure, Chad. I said, I don't know. Can I work you into your schedule? Because Chad is frequently a speaker on CNBC. You'll probably see him or recognize his face. CNBC, Fox News, Wall Street Journal, a number of the different outlets, CBS Radio, Bloomberg, BNN. I can keep going down the list, but clearly he is recognized as a good authority for what he talks about in the area of finance and investing, and I'm excited to hear what he has to say. So I'm going to shut up and let's turn it over to Chad. Chad, come on up here.
I want to thank Tom. He's such a great public speaker. I wish I can pay him to do my presentation for me. All right, so let's light this candle. I've been in the industry for 30 years. My name is Chad Morganlander. My partner, I got lucky because my partner, Kevin Karan, and I, with Joe Battipaglia, who was chief strategist back in 1992 at Gruntel & Company, we founded Washington Crossing Advisors in 2002. There's a couple of things that I'm going to weave in here. I'm going to try to distill highly complex economic numbers and all this stuff that you're seeing on business TV as well as political TV into a very simple kind of construct and matrix. And I know that we're going to be more or less-ish wrong and more or less-ish right. But I believe overall in the long run, by following what we've learned and all the mistakes that we've made over the last 30 years, that you'll be better off at the end of this presentation. That's my hope, all right? A couple of things to note. I do truly respect that you are all entrepreneurs here. Many of you have businesses, and I know how hard it is to start up a business. In particular, because throughout time, there's always going to be a massive amount of uncertainty that will hit the markets, as well as the U.S. economy. And we're going to have more of that over the course in the next 5, 10, 20, 30 years. I'm encouraging you all to focus on economic trends, to be mindful of the long run, and not be so short-sighted and myopic about little mini trends that happen within the US economy that can derail your business investment or derail your portfolio's investment. So a couple of reasons why I say that is because I would like to just let you know that in 2001, during 9/11, I was in the World Trade Center. It was a beautiful day, beautiful blue skies, and it was an easy commute in. And wouldn't you know, as I was entering the World Trade Center, the first plane hit the building. You would have thought at the end of that day, after the buildings fell, that the US economy would have been in an absolute tailspin, that the stock market, New York Stock Exchange, would never open again. But in fact, we did. Eventually, we bounced back. There was fiscal stimulus. There was a lot of support from the Federal Reserve, and life went on. So when you're watching TV and the election is happening, whatever side of the aisle you believe that it should be right or wrong, I'm encouraging you all to just look at the next 10, 20 years. And there's a lot of positives to come from that. So why are we investing? Why exactly do we invest? And what is the purpose of investing today in the stock market? It's to beat the rate of inflation. So let me give you an example. In 1971, I was born. So now you know how old I am. I'm 52. How much do you think a new car was in 1971? Ballpark. Someone said 3,500? Bingo, that's exactly right. The average new car was $3,500. Today, I think it's around $40,000 to $50,000. A hamburger back in 1971. 25 cents, winner. 25 cents. Okay, you all know what it costs to get a hamburger today, depending upon what fancy place you go to. And I'm just gonna, do a movie ticket back then, and then I'll stop, I promise you all, okay? It was $1.50, all right? So we all know that inflation is really what we're trying to beat when we are investing in the US stock market or international stock markets. And you should consider this with your business investment as well. A couple of other things to kind of know about the world. This chart also gives you a little bit more of a short-sighted view of it. Now, 30 years ago when I started in the business, no one sat me down and told me how the US economy runs. And I know that traditional economists will get upset about what I'm about to, whisper to all of you. But the reality is money growth within the United States, the actual expansion of money is what drives the US economy. And it's what drives S&P earnings, and it's what drives prosperity, and it's what drives inflation. So when you look at the US economy and you see how it's expanding or contracting, the major reason for that is a deceleration if you're going into a recession, or an acceleration if you're expanding in money growth. So just consider that when one takes out a mortgage or business loan to reinvest back into their business, they're creating more money, which is creating more expansion. There's another thing to note, though, on this chart that a traditional economist would get upset about after I just said that. I'm going to give you the more traditional way of looking at the US economy. This is like if you went to Harvard Business School, and they would say that it's capital investment, it's the expansion of the population, as well as worker productivity. And I'm here to say that the US economy today is expanding, and it's actually growing at a far greater clip than the Federal Reserve was anticipating. Hence the reason why the Federal Reserve is having a hard time lowering interest rates when the US economy is growing at a 2 to 3% clip. Now, if you use the traditional ways of looking at the US economy, you have productivity that has been increasing and it's going to continue to increase because of the use of AI. We're going to get into that in the further slides. Capital investment, look no further as Arizona with Taiwan Semiconductor and Intel as samples. Capital investment in the United States and onshoring has been quite robust. And of course, something that has been a drag to the US economy is now actually starting to increase, which is the population. In fact, surprising, the statistic used to be when I was born that the population was growing at 1.25 to 1.5%. Today, the population grows between 0.5% to 0.75%. That deceleration of our population could be a major economic drag. And I just want to just let you know, the only way to fill that gap in is people need to either reproduce more children or you need to bring more people into the United States. Whichever side of the aisle it is, that's how the United States has grown. And the corollary, the opposite of that is Japan. Japan's population has been contracting. And what would you say about Japan? They've been stuck in the mud in a recession for the last 20 years. So this is the chart about inflation, expansion, and I told you the two ways that this works in regard to the US economy growing. Now, what we do at Washington Crossing Advisors, what I'm going to do in this presentation, because that was just my little introduction, okay, is I'm going to take you through the US economy. I'm going to take us on a foreign European trip around Europe, and then I'm going to take us in a more exotic trip to the emerging markets to just show you how the global economy grows. And then I'm going to come back here to explain how I think you should invest over the long run. This is now a more shorter term viewpoint on the US economy, and it's more myopic in its nature. It shouldn't push you in one direction or another to become bullish, or too bearish. Just keep notes in regard to how the economy is functioning. At Washington Crossing Advisors, we created a barometer of 30 different indicators to give us a non-biased viewpoint of how the US economy and the global economy is doing. Now, Kevin and I have been on CNBC hundreds of times, or Bloomberg, and there's always a bull that's always going to be very bullish about the economy, and there will always be a bear. And I can promise you right now, if you gave me a mic and you told me in 5 seconds, be bearish, I can scare everyone in this room where you won't sleep at night about the US economy. And then vice versa, I can be very bullish. This is a non-biased viewpoint. We're looking at 10 US economic indicators. We're looking at 10 international indicators and 10 credit indicators. Why do we look at credit indicators? Well, it was very interesting because at the presentation at the beginning, a well-functioning credit market actually is a well-functioning economy. You need credit in the US as to function in a very smooth and tranquil way where the credit is growing in order for that locomotive to continue to go forward. So this little chart here is showing you that we're still in expansion mode. Bloomberg just had an article today that says a majority of Americans think that we're in a recession, and that's just not true. We're actually expanding. S&P earnings also are doing well, and you'll see that. Consumer sentiment. Well, this is another chart that is a survey. I don't really hold a lot of weight in this survey, but it is showing you that there's a positive trend within consumer sentiment. And that goes into more of a bullish outlook because consumers are roughly about 60% of the US economy. 12% of the US economy, additionally, is healthcare, and the rest is actually of the US economy, if you break it into a pie chart, is business investment. The reason why I don't like this survey is because they call people on their phone and they ask them at dinner time how they feel about the US economy. And of course, you're going to be mad at them when they do that. But it does show that it's positive. A couple of things to note about the overall economy. The labor participation rate, right there, as well as the initial jobless claims. The labor participation rate that 7 years ago was 67%. The definition of the labor participation rate is really quite easy. 67% of the population in the United States is working. Now it's 60%. A majority of that is degrading of America. People are retiring. What's shocking about a little bit of this is that about 1 to 1.5% of the labor participation rate being so low is due in part because of the opioid issue and the drug issue in the United States. In fact, oddly enough, about 1% of it is from male participants and 1.5% is from female participants. That statistic totally blew my mind. So this, although is somewhat a little bit confusing, because if you look at the labor participation rate of working age people from the age of 20 to 45, it's at an all-time high. So just something to kind of parse when you think about it. When you're listening to television, they say, well, the labor participation rate is lousy. Well, I can give you the bearish story or I can give you the bullish story. But we're at a full employment picture, and I know that because if you go and you look at every week the initial jobless claims number, now let me tell you what the initial jobless claim number is. A definition is the unemployment checks. So people get fired, they go to get the unemployment office and Social Security office, and they receive their unemployment check. That number right now is low 200s. When I started in the business in the 1990s, that was around 300,000. So what this is telling you is that we are in a tight labor market. People are not getting let go or laid off, and it bodes well for consumption. It bodes well for the economy. If you wanted to be an armchair economist, which is a lot of fun to do, look no further than at 8:30 Eastern Time every Thursday. If you see that labor participation rate gliding higher, meaning goes from 200 to 300 to 350, you can call a recession and you're going to get it right. But you're not there. You're not there yet. Manufacturing, well, now that there's an onshoring of factories, it's slowly starting to pick up the manufacturing numbers. Any number under 50 on this ISM report would indicate contraction in manufacturing. It's our belief that this number is going to be well above 50 over the course of the next 3 to 6 months. And going into 2025, we're going to really start to see the engines kind of kick in. There's a lot of factories that are being built in the Northeast Corridor, not only here in Arizona, and you could see that there's actually a drumbeat that's actually starting to occur here in the United States when it comes to manufacturing. Surprisingly enough, manufacturing used to be the real heartbeat of America. It's only 20% or so of the US economy. It's non-manufacturing, service jobs that are now a majority of the US economy. I will tell you, this is a very, very bullish indicator. If we can raise our percentage of manufacturing here in the United States, you'll see a lot of places like in Lebanon County, PA, or Martinsville, Virginia, which have been gutted by offshoring of manufacturing, start to become more vibrant again. And I believe that that's really one of the political things that both sides of the aisle have to focus on. And you could see that they're starting to. Should have been done about 30 years ago. Okay, so here are the tailwinds I'm going to give you for the next 2 years, 5 years, 10 years, and I truly believe 15 years. But I'm not going to only give you the tailwinds. I'm going to also go and give you some of the headwinds on the next bunch of slides. By the way, we have about 95 slides to do, so just buckle in here. But we're going to do them in 13 minutes. I'm just joking. It's going to be about 5 more slides, I promise you. Okay. The CHIPS Act, we'll start there. There's over $110 billion that the federal government has now indicated and earmarked, both sides of the aisle, to now bring the chip manufacturing back to the United States. It's remarkable that they haven't done this. They just figured this out after COVID, that China maybe is not our best friend. It's remarkable. And this has been going on now. They're indicating now that they're going to kick this in. It's not only Taiwan Semiconductor as well as Intel, but you're seeing also Qualcomm and other chip companies and that are going to continue to Texas Instruments that are going to continue to build fabrication plants across the United States to become less reliant on Southeast Asia, which that's going to take around 10 years to 20 years to really get this up to speed so that it's not a domestic, I should say a threat when it comes to military threat. Because right now we're way too reliant on China, the manufacturing in Taiwan, and it is a soft spot that they have to kind of kick in, and they have to accelerate. The other Inflation Reduction Act, like it or not, this has been also earmarked. A couple of things to note about this: it's to build out, of course, green energy. I will tell you though, some of that is earmarked to oil and gas the industry, and wouldn't you know? Just as a positive tailwind, the oil and gas industry right now. We're the largest producer in the United States, largest producer in the world, rather, of oil and gas. We are the largest exporter, way larger than Saudi Arabia. And who would have thunk it? That's a real tight, good tailwind, and a lot of business investment's going to continue because of the Inflation Reduction Act, and you're going to see a lot of innovation there. We need that from that perspective. And then you have the Infrastructure Act that has been put in place. Now, this is creating a gigantic amount of deficit spending. It started back in 2016, and during COVID, they really accelerated it because of COVID relief, God bless you. And that also was expanded with the Biden administration, where you have this gigantic deficit of around 8% of GDP. Historically, that number is around 2 to 4%. So you could obviously, take from that the federal government has been issuing debt in order to take on all of these initiatives. And it's both sides of the aisle that have been doing it. One side can't point at the other side. They're both ginning up the economy. Some of it is to remake the U.S. economy, and some of it, though, I believe is wasteful overall. But again, it does bode well. Artificial intelligence. We should really talk about this and kind of go through this a bit. This will create a tremendous amount of worker productivity. And wouldn't you know, I started the conversation talking about how the economy grows, and a portion of it is growing due to part to worker productivity. That's if you look at the traditional formula for it. That can enhance productivity by the GDP by 1 to 2 percentage points, maybe possibly 3 at any given point in time over the next 3, 7, or 10 years. So yes, it's scary. Maybe robots will be chasing us around trying to, like a Terminator, down the road. But for the time being, it's going to gin up the U.S. economy. I will also tell you that like the space race or like post-World War II, this from a positioning of a power structure, if we do not win this race, then it's not going to look great for the U.S. economy and or our military over the course of the next 10, 20 years. This is more of a challenge and a threat than the highlights of who's going to invade Taiwan today. Something to be more mindful of. So if the federal government and government can get out of the way of business, in particular when it comes to artificial intelligence, this should bode well. So GDP expectations, this is a third party, 2.4%. I wouldn't be surprised if it lands around 3%. That would be my long run expectation over the course of the next 3, 7, or 10 years. The Federal Reserve's at 1.75 currently, so they may have to up their expectations for GDP growth. That's called potential GDP growth, due in part because of all those tailwinds that I spoke about. With that said, that means the Federal Reserve and the interest rate environment you're in today is more of a normal interest rate environment that we all grew up with. The abnormal interest rate environment was when the 10-year bond was trading at 0.5%. Sorry that I speak so fast. I'm from New Jersey, so I apologize for that. Okay, so I gave you all the good stuff. Well, a couple of things just to kind of keep an eye on here. Possibility of Fed rate cuts. Well, we started the year where everyone was expecting 6 quarter-point rate cuts. That obviously isn't coming to fruition. The U.S. economy is growing at a higher rate. Inflation is stickier than they originally thought at 3%. They want that to come down to closer to 2%. So they are going to hold, the Federal Reserve, and not cut rates at least for the next 3 to 6 months. Unless there's a financial dislocation, a credit dislocation, they're going to keep it there at 5 to 5.25%. What they have done, though, is they're going to slow down the reduction of their balance sheet from quantitative easing. That balance sheet adjustment is now going to be decelerated, which is going to at least keep financial conditions quite loose. Now, here's the reality of it, which kind of blows my mind. Financial conditions are extremely loose. I look at it from two perspectives. One, as an equity investor, this is what they call the equity risk premium. This is like how much risk is in the stock market. And if you go back 20 years with this chart, that number of 0.6 tells you that you're not getting paid well for taking on the risk right now. In fact, it's quite loose, quite tight. There's a lot of ebullient fervor within the stock market. If you look at it from the other side, from debt, it's even worse, meaning credit spreads on bonds, bond investors are willing to pay anything to get a good credit. In fact, my partner and I just sold Google bonds out of one of our fixed income portfolios that was actually yielding less than the Treasury with the exact same maturity. So what this tells you is that credit investors, bond investors, as well as equity investors are very giddy right now. They're not forecasting any type of recessionary trend within the economy. It's pretty wild from that perspective. A couple of things to note about this is that the multiples, although they are not valuations, are not in nosebleed territories. That's a financial word. That goes back to 1999. They are somewhat stretched. One of the reasons for it, though, is because the U.S. economy is growing at such a rapid clip, and also because operating margins, profit margins, are now historically high. That, to me, is really the reason for the multiple being where it is and why the stock market is where it is today. But to kind of give you like a little bit of a historical walk down the street, GDP, the stock market now is trading at 2 times GDP. Now, back in 2009, the stock market was trading at 0.6 times GDP. And on average, the stock market trades at 1 times to 1.25 times GDP. So for the markets, they are high from a valuation perspective, but a lot of that valuation is being driven by a select few companies. It's not all companies that are overvalued. You may have a select 20 companies that have driven up the valuation of these general indexes. So again, for me, I'm not terribly concerned about our portfolios at Washington Crossing Advisors, but for the broader markets, there are a select niche of group of companies that are in a bubble mode reminiscent of the dot-com era. I promised you that I was going to go through the global economy. Just to kind of give you some context here, the U.S. represents 26% of global GDP. Our European friends of the European Union represent, including Japan, about 32% of global GDP. Emerging markets, ex-China, 25, and China's 17. Now, here's the reality. Back in 2000, now I'm going back 23-ish years, the Chinese economy was only 3% of global GDP. And what they did was they decided to move from an agrarian state to more of an industrial state by not only leveraging their balance sheet and making nonsensical investments, but also building cities, taking on a lot of initiatives, economic initiatives that were good for China, but not so good for the United States. Hence the reason why the realignment, economic realignment, is starting to happen, not only with the United States and China, but the Europeans and China. So the Chinese economy used to grow at around the 12% handle, and now it's decelerating. It's roughly about 4.6%. We expect it to continue to decelerate. It actually represented, the emerging markets represented at one point in time, including China, it represented roughly about 65 to 70% of global GDP growth. It was really the engine, the caboose for the growth of the global economy. The hope is now that we're reinvesting back in the United States, that now we will see our growth rates gin up. We will see the benefits of our employment picture with wage inflation overall over the long run. But the other thing to think about is India. India now, with 1.4 billion people, has become more capitalistic. They're actually friendly when it comes to business investment, and you're going to see a lot of corporations move from China to manufacture within India as well as Indonesia and the Philippines and Vietnam. A couple of things to get a little bit more myopic about the Eurozone. They're about 2 steps ahead, behind us when it comes to the economy, but they're on firm footing. They're starting to grow. The odd thing about the Eurozone, which we need to kind of be very real about, it's kind of like a bumblebee, the European Union. It's flying, but it shouldn't be flying. And why I say that is there's 19 nations. They have 19 different social safety nets. They have 19 different cultures, 19 different elections, hundreds of different political parties and political affiliations, and 19 different business incentive programs that each country have and share that don't share. So besides having a license plate that they're unified about, or a actual central bank like the European Central Bank, the European Union is really in a tricky spot when it comes to gathering and working as one. Surprisingly, they have when it came to the invasion of Ukraine, but any type of economic downturn where you have a nationalistic president or whatnot come into power in one of the major countries, that can cause a major dislocation of that partnership. And it's something to keep one eye on. I'm quite surprised on the stability of the European Union, and I've been very wrong over the last decade on that one. China manufacturing, just to kind of get back to China a little bit, you could see here that it's now contracting. Anything under 50 represents a actual contraction of growth of manufacturing. About 2/3 of investment in manufacturing that from U.S. corporations is now moving out of China and going elsewhere. So it is a real readjustment of the footprint of the procurement system and how companies are conducting themselves from a logistics resilience perspective, and also perhaps from an incentive perspective, as you see incentives improve here to move your chip plants here. Okay, so where does this leave us? All right. Right now, over the next 12 months, or up until the next, let's say, until the end of the year, we think the U.S. economy is on firm footing. This is the more myopic viewpoint. I gave you kind of a disclosure. This is, look at longer term views. That inflation will come down a bit, but the yield curve will be stubbornly high. but it's not stubbornly high for any other reason because the US economy is growing, and that's a good thing. Inflation, the reasoning for that big massive spike in inflation that we all saw over the 2020 into 2023 was due in part because the federal government and the Treasury and the Federal Reserve, and actually, it wasn't only here in the United States, international governments, what they did was they just produced more money. And then they used transfer payments across the globe to give people more money. And when doing so, when you add more money into the system, you create more inflation. You created a little bit more of an economic tailwind with that as well. But overall, it's not a really good practice to gear up the economy over the long run with Keynesian economics and running a budget that's so wide. So our expectation is, and our hope is that that the current administration or any other administration going forward over the next 10, 20 years will become a little bit more mindful about fiscal policy because that to us is a very important anchor for our reserve currency. A couple of things also that we want to think about is geopolitics and our role in that. And what I would suggest in regard to how you should look at this for your business and also more importantly for your portfolio is to ignore it. I know that that's crazy for me to say, but after 30 years of doing this, I can't tell you how many times that I came around, heard something, moved something in the portfolio and our tactical asset allocation portfolios, and was completely wrong-sided on that trade. Over the long run, and I started in this world in 1971, the S&P 500, when I started, was 98 points. So that's what it was in 1971 around August 30th. Today, it's 5,300. Through that, you had the Vietnam War. You had dreadful decisions that were made politically. You had credit dislocations like the banking collapse that happened in 2008. You had the dot-com era. You had 9/11 that I was an active participant in. And I was actually an active participant in the first World Trade Center bombing too. And yet what happened was the US economy continued to move forward. And I would just give you the advice, don't bet against the US economy, regardless of whatever viewpoint you have on who is in power or what's happening within the world. A couple of things to note about how we think you should invest over the next 10, 20 years. When I founded Washington Crossing with Kevin Caron and Joe Battipaglia, it was after the dot-com era and 9/11. And what we do at Washington Crossing Advisors is we decided we wanted to create equity portfolios that were well-grounded. In plain spoken English, we wanted companies that were going to stay in business and grow over the long run and even in a recession. So what we did was we looked at three things to focus our attention on what type of companies we wanted to buy. And here's the advice I can give you. Buy quality companies. And my definition, I should say our definition at Washington Crossing Advisors, is to buy quality companies that share three watermarks. One, buy companies that don't have a lot of debt. Because as you all know, living your lives, people that have a lot of debt, when there is an unfortunate accident, either they lose their job or whatnot, then hard times really fall on them. And you've seen that with companies that have a lot of debt, like Enron, WorldCom, Lehman Brothers, Bear Stearns. They had a lot of debt, and that's the reason why they're no longer in business. That's rule number one we follow. Rule number two is buy companies that are very durable, meaning that they're going to have earnings even in a recession. Now, these are not the flashiest companies in the world. No one's going to pat you on the back at a cocktail party, and you're not going to be posting about this on Twitter about how awesome you are that you bought NVIDIA. But let me tell you, NVIDIA, there was a company like NVIDIA back in 1999 that was the largest publicly traded company in the world, Cisco Systems. And it's no longer the largest traded company in the world. In fact, it's never hit that price again. So you want to buy consistent, steady Yeti companies in regard to free cash flow that are well diversified from a client base, well diversified from a product line. The third part is the most important part. The reason why Microsoft, the reason why Google became the largest companies in the world is because, like a business investor, they put $1 into their business and they grow their business rapidly. So they take $1, they invest it in the business, and $5 pops out of the cash register. That's called return on invested capital. And you want to buy companies that have a higher return on their invested capital than their cost of capital. So I told you about Microsoft and Google. The opposite of those companies is AT&T and Verizon. They turn around, they reinvest back into their business, and it's very difficult for them to get a high return on their invested capital. And you see this many times, and you wonder, well, why doesn't AT&T and Verizon stock go higher? And it's because of that. The headwind is they're not generating a good return on their invested capital. They're not growing. They're contracting. They're taking on too much debt for uneconomic projects. So at Washington Crossing Advisors, we're a quality manager. We run a rising dividend portfolio that has to increase their dividends, and each company grows their dividend, its growth of income portfolio, using those three principles. And we also run an all-cap portfolio. These portfolios are quality. They're not there to light the world on fire. But what they are there to do is beat the rate of inflation at a steady rate, beat the markets when it comes to volatility, meaning there are lower volatility portfolios, which basically means that you're not stressed out when you put on CNBC and Bloomberg and you see the market down 25%, because you know each individual company in that portfolio will be growing, profitable, well-capitalized over the long run. These are the simple rules that we follow at Washington Crossing Advisors. And I believe that over the long run, everyone that invests that way would be better served. Avoid story stocks, avoid speculative projects, and just stick to very basic, well-understood companies that have those three attributes. So with that said, I am pretty much done with the presentation today. I just want you to know that I do weddings, bar mitzvahs, christenings, and whatnot. And I'm sure you have Q&A for this. And you know what we're going to do is really keep it real in regard to being honest in the Q&A. This is my favorite part.
If you do have questions, please raise your hand and we'll bring the microphone to you. This is being recorded, so we need you to ask your questions into the microphone. Thank you.
Does your firm have a take on Bitcoin?
No. The reality about Bitcoin is it was created as a hedge, perhaps, for and it's similar to gold, a currency hedge, and we don't invest in that. We want to invest in U.S. corporations, in particular, that are growing, profitable, well capitalized, so that we can own them for 20 years and not twitch if there's a Sam Bankman-Fried that turns around and rips off the public. So I know that there's a lot of speculative excess within that sector, cryptocurrencies, and I just say buyer beware.
Do you have a minimum portfolio, and what type of fees are involved?
I'm sorry, can you repeat that? I apologize.
Do you have a minimum portfolio that one could bring over, and what type of fees are involved?
So Tom's going to answer that.
Sure, I'll answer the question. Actually, with One EZ Wealth Management, we actually have a variety of platforms that we help investors, and Washington Crossing is just one of hundreds of different investment strategies that we have available. The question about size really depends on one of the platforms. But if I had to give a generic answer, I would say $10,000 is generally where we kind of look at to start when we get into an investment of something on his style. Usually they're larger though. But the fact of the matter is, it's most important is to understand what's in the best interest of the client. But yeah.
Thank you. Is it me? Okay. I noticed you didn't mention anything about real estate there, both in Arizona and locally here. What's your stance on a REIT? Do you invest in that for clients, or how do you look at real estate?
Yeah, thank you for the question. So real estate there are two forms of real estate, residential and commercial real estate. When it comes to commercial real estate, we believe that it's quite vulnerable, in particular in certain types of pockets, like, for example, office space region and whatnot. That will have to be recognized by banks, be written down, because obviously the work from home transition that has occurred post-COVID has taken a little bit more of a has had much more of an economic effect on many undercapitalized commercial real estate projects, which effectively what I'm telling you is that regional banks may be somewhat more vulnerable to those commercial real estate loans. When it comes to residential, we don't see a problem. You may start to see a slowdown, due in part because of mortgage rates going so much higher. When they were 3%, 2%, you can get a mortgage. Now you blink your eye on the exact same amount of money, and it's a multiple that you're paying per month, which is going to have some drag on the real estate market. Hence the reason why the Federal Reserve is continuing to keep the short end of the yield curve high. They're hoping to slow the economy down, to slow inflation down. And in particular, one of the channels of doing that is to slow the real estate market down. That's one of the reasons why they do what they do. So short term, a little bit less optimistic, but Arizona has its own heartbeat because of people moving into Arizona. And in particular, when it comes to the Phoenix area, for example, I just mentioned at the table, it reminds me a lot of in Alabama, there is a region in Alabama that they call the rocket capital of the world. And that region, the real estate there is booming. And it's because of all manufacturing coming in, similar to what's happening with Intel and Taiwan Semiconductor.
Does that mean I'm up over here? It's on then. I'm just trying to discover your trading philosophy a little bit more. You mentioned that the stock market was trading at 1.25 traditionally of GDP, now up at over 2. Does that make it the price to book a little bit more important? And does that make you a little bit Benjamin Graham sort value investing?
Thank you. I didn't pay him to ask that question, so thank you. Should have told you that. I just did. I saw Tom looking at his watch, and I was like, maybe I should just hope that I get it down on this one. Okay, so here's our way of valuing companies. We value companies looking out 5 years, not 1 year. 1 year is a trader's perspective. We're business owners. And in fact, when we do that, we're not only looking at the total market cap of the company, but we look at aggregated amount of debt. And we call that enterprise value. So not only looking at what the stock price is trading, total issuance, but everything, okay? Similar to how a private equity firm would look at a company. And then say, where do we think these steady Eddie companies' cash flow and revenues will be 5 years from now? It's similar to, and I like to tell the story, and I promise I'm going to do this in 20 seconds or less. If we were all going to buy a bagel place at Brooklyn Bagel Works in Brooklyn, New York, and I said to all of you that the bagel place is generating $1 million of earnings, and we're going to buy it for $1 million, you would say, great. This is a no-brainer. Let's go buy it. We just need to keep this thing open for 3 years, and we're going to make a lot of money. And we all took an airplane to JFK, and we got into Ubers, and we all went to sign on the dotted line to take on the deed. And you saw an asterisk there. And the asterisk says, by signing here, you not only you have to put up $1 million, but you also are going to take on the existing debt of Brooklyn Bagel Works That's $20 million. What would you do? What would be your reaction? You would think that I just tried to pull the wool over your eyes. And the reality is that a lot of investors not just don't look at market cap, that's PE multiples. They say, oh, the PE is low. Well, no, you got to include the debt. When you do that, AT&T and Verizon, they have $120 to $150 billion of debt. It looks great when you look at it from a PE multiple, but let me tell you, when you add the debt, it's not so great, and the return on invested capital is horrible. Great question, and thank you for doing that. I owe you $10.
Okay.
Yes.
Hello, Nick with Medina Hospitality. I have a question on the valuation in terms of inflation. So you had mentioned that the price increases, we've experienced that within the last 2 years. Home prices have doubled, equity prices have tripled, and that's all probably because the Fed is, the M2 money supply has increased something like 70% within the last two years.
Mm-hmm.
And so really the investing, you're not only trying to keep up with inflation, you're trying to beat it
Yes.
at the same time. But why wouldn't you want to take on more debt at that point in time when rates were low? Because aren't you shorting the dollar by doing so in taking on debt?
So there are people that do that. When rates were at 10, when the 10-year was at 2%, that one would say lever yourself completely in order to do that, to get that arbitrage between inflation and what you're paying. That was a wonderful opportunity to do that.
Gotcha.
Okay. That's not our game.
Right.
Debt to us, we're very plain spoken in regard to how we invest. We figure that eventually that debt is sticky, right? And then that debt has to be rolled over eventually when there's a maturity or a reset on that debt. So commercial real estate companies now have that problem in a way. They may have taken on debt, but their trigger for when they need to roll over that debt, now they have to roll it over at a higher prevailing rate. So it looks hunky-dory at the beginning, right? But then what happens if inflation kicks higher? Maybe my inflation number's wrong. Maybe you go into a 1970s type of spike in inflation, because I could be wrong with that. I told you at the beginning I may be wrong about some certain things. And now all of a sudden, you took on $1 billion of debt, and now instead of refining it at 3%, you're refining it at 12%. Say goodbye. And your cash flow may not have kept up with that. Now you're playing the cash flow race, which, by the way, a lot of times doesn't end well. And the investment bankers at that point in time, when you try to call them up, are nowhere to be found. All right?
Yeah. One other question too, as the dollar decreases value and they keep printing more and more and more, and the dollar eventually loses its dollar reserve status.
Mm-hmm.
How does that affect the multinationals with a strong dollar and us having a weaker dollar here? And
so typically a dollar strength would happen when less dollars are put into this system. So what effectively happens, and you have to all understand that there's all of these reports about the reserve currency and we jeopardizing our reserve currency. I'd like to remind you that there's no other currency right now currently to challenge it. The European Union, we spoke about the bumblebee effect. They don't want to be the reserve currency. China, in order for China to be a reserve currency, they have to actually allow money to leave their country. And go figure. I'll tell you, they don't allow money to leave their country. So it's kind of like the Roach Motel. So they're not going to be the reserve currency anytime soon. In fact, if they even remotely unplug that restriction, money flows out of China, and then you see a chaotic economy there, and then the political ramifications start to kick in because of discontent. Now, I talk a lot sometimes and I forget the question, so I need you to understand that I may not have answered your question directly, but the reality is that when you did have it right, 30% more money was pumped into the system, and you got that recession, you got that inflation spike, it came down, and as the deceleration of money came down, so too did the inflation number, and now it's moving a little bit up, hence the reason why you have that 3% stubbornly high rate. Credit growth also plays a role into that.
Hi, I'm Linda. Can you name a couple of companies that specialize in AI that meet your criteria?
Yes, perfect. Thank you. Microsoft. Oh, we own Microsoft. We've owned Microsoft for over 10 years. Google, for example, as well as Oracle. Now, I will tell you that some of these companies, like the .com era, they first, you recall Netscape, right? And many of the older people that remember, in 1992, there was something called Netscape. It was supposed to rule the world, or US Robotics, and it's no longer to be found. So the winners today may not be the winners tomorrow. Amazon was a little company that was selling books, rode up on the book sale only to crash 95% after the dot-com wipeout, and then to recreate themselves. So just be mindful that these mega trends that are happening, it doesn't always work out the way that people hope, and be very conservative with it when investing. Hence the reason why you want to have Microsoft right next to a company like Procter & Gamble or Church & Dwight that makes Arm & Hammer baking soda and OxyClean. Mind you, you'd think that boring company wouldn't make any money. And it's gone up, I think, roughly about 3 to 5x over the last 15 years. They make cat litter. Okay.
Could you speak to the insurance component in investing? Where would you advise clients and on the role of insurance-related instruments? And do you have any concern about insurance companies that may be overextended?
Okay, so from a financial planning perspective, I don't have a view on that. I will tell you that insurance companies do have a portfolio of assets, obviously, that they're managing in order to pay out their claims. And some of these insurance companies are better than others. The adoption of derivatives into this world, derivatives being what happened with AIG and whatnot, has amplified the risk in certain pockets of the insurance market. Washington Crossing Advisors avoids those companies, due in part because of that black box effect, that we don't want to take on companies that we can't see clearly through it. And hence the reason why we don't buy broker dealers, we don't buy big banks, we don't buy regional banks like Signature or Silicon Valley because of leverage and less opacity to us. We need clarity.
Hello.
Hi.
You talked about population deceleration and the economic drag of that. And I was thinking about the, what I think last number I'd heard, over 13 million who have crossed into our country under asylum or whatever it is that brings them here. And how does that sudden increase in population affect the economy? And is it something you even compare as far as population?
Okay. So this is the third rail. And right off the bat, my mentor told me that you should never touch the third rail of anything, because at Thanksgiving, when you touch the third rail, half the table wants to kill you, and the other half of the table, well, they like you for a minute, and then they want to kill you when you touch the third rail again. All right. We being all of us, need to figure out how we're going to address immigration. And shame on both political parties for politicizing it, because it's now an economic issue and who we want to be over the long run. I do not agree with illegal immigration at all. Okay, you gotta please understand that. But how the effects of immigration, people coming into the country, what we've seen is, oddly enough, the economy has improved due in part, I'm telling you, this is a weird, odd thing, due in part because of an influx of additional humans into the United States. I know it comes with other issues. I'm well aware of that. But if both sides of the aisle could actually come together with a proper immigration policy that everyone can walk away from the table feeling good about, and we could increase immigration in a legal way here over the long run, not talking about 12 months, I'm talking about the next 100 years. Okay, that's what I'm looking at here. Then it's going to bode well for our growth rate. Japan didn't do that. China, one-child policy, they're now, it's the wheels are falling off their economy because of it. Our replacement rate, birth rate, unfortunately, because of maybe the iPhone or Netflix, I have no idea, okay, all right, is actually, the replacement rate is low, it's scary low, and it decelerated quite rapidly with the birth of the iPhone and the internet. So I don't know what to tell you about this. I'm not running for office here in Arizona, okay? But it's just, this is the reality that we're all dealing with, and we have to all come together as Americans. And I will tell you that everyone, because I travel around the country, maybe I should be a politician, but I travel around the country and we have a lot more similarities, way more similarities than we have than differences when it comes to every type of issue that is being politicized on TV. I will share a story, and then we can go to another Q&A. I do CNBC, Bloomberg, Fox, and whatnot, and I would just suggest that everyone just shuts off their TV now. And then the reason why it really became clear to me was I was interviewed and I started arguing with a individual about oil prices, and I misbehaved on TV. And I was scared after that commercial break that my wife was going to kill me. Okay. I mean, I was terrified. Okay. I'm like, this is it. I'm dead. And the reality is, you know what the senior producer said to me? He said, that was the greatest you've done on our show. Thank you so much for doing that. That was telling. That meant to me that he didn't want someone to give a rational behavior, have a nice conversation and, try to be friends. He wanted me to amp everyone up that was looking at me on TV to get everyone agitated. Thank God my wife didn't see that segment.
One more here.
Yes.
Dane Cusimano with Credit Union West. I saw that segment and it was interesting. So my question is on a fiscal basis, how do we encourage the United States? What type of things can we be doing to encourage growth amongst ourselves?
Now I'm going to.
We talked about immigration.
Yeah,
immigration. I understand that.
Yeah.
What I mean is from birth rate from the United States.
Yeah.
How do we encourage that?
So I think that if you incentivize, this is
birds and the bees, maybe.
You can give them tax breaks, right? I mean, to make life easier for everyone. That too would encourage, and that perhaps is a long run solution that, hey, if you turn around college education, also perhaps making sure that it's more affordable because now it's about, $600,000 for an education at a private school, if you are born today. So thank you guys for everything.
All right, great. He's staying here. Yep. Thank you, Chad. I have a couple comments I want to close with here. All right. First, thank you all for staying and listening. And this happened yesterday. We had to shut it down with so many Q&As. We're going to stay and be able to address any other individual questions that you have. And that's what is so unique about investing. It is unique and personal. So I'm sure there's individual personal questions you might want to ask. We're going to be here to address those with you. We talk about speculation. That's what? Gambling. And on the other end of the spectrum is investing. And that's truly making decisions for long-term growth. Not speculation in the hopes and the gambling effect, but really sound basic fundamentals when it comes to strategic thought in the process of selecting investments. And That's one of the things that I liked about Washington Crossing is it's very, very thoughtful. He used a phrase a few years ago when we first met each other. He says, Tom, trust me, this is something you can put your mother's money in, and she'll still like you. And she won't call you, and you'll be happy when you get the inheritance. But no, in all truth, it is about investing, not necessarily speculation. That's number one. Number two, was this a good event? Did you find this of value? Okay, great. Thank you. Thank you. In order for this to continue, now here's your ticket to get out. The feedback form, so critically important. We need your feedback form. The Prescott Chamber needs this feedback information. Also, the college wants your feedback information. So please, I know nobody likes to do surveys. Please fill it out. And also, as I mentioned earlier about the biz equity analysis, if you have a business and you would like us to do that business valuation or business analysis for you, we will do it for you as a complimentary service. Just let us know on the note here. We will follow up directly with you. You will be very, very impressed with the analysis. All I have to say, please take advantage of that. All right, as I close, and I want to turn it back over to our co-host here, I want to say thank you so much for your attention. I was asked when I arrived today, did I bring the chocolate candy bars again? And the answer is yes. There are some milk ones and some dark chocolate ones. So please enjoy, and I thank you so much. Can I say that we might see you next year? Yes. All right, thank you. Take care. Have a healthy and wealthy rest of the year.
Wonderful. Thank you so much. Let's thank 1AZ Wealth Management and 1AZ Credit Union. Give them a round of applause. And Chad, thank you so much for that. And I also want to thank our host, our lovely host here on the college campus, Yavapai College and the REDC. I just also want to, you kind of took away, I had my candy bar ready because I remember when these were 25 cents. Do you guys remember that? So, but I didn't know about the dark chocolate, so I'll take all those. But no, I just want to share first of all, thank you again. This is great programming, and we will definitely be looking to put this back on the calendar for next year. But I also want to encourage everybody to continue to shop locally. That's so critically important for all of us to be shopping brick and mortar, shopping locally here. And I also want to share with you that we're about ready to enter into very busy season for this whole region. We have a lot of events coming up. We have the rodeo coming up. This weekend, we have up at the Pine Ridge Marketplace, the Off-Street Festival, along with the Phippen Museum Fine Arts Show that'll be downtown. Just a lot of things. And I just want to share with you that in the next 6 weeks, we're going to be creating a $68 million economic impact for this region. We're also going to be creating over 700 jobs and putting $5 million of taxes back into the system. That's what the region does. Thank you. And so I want to thank all of you that participate in that are sponsors of that are volunteers for that, because that is what creates our economy, and we need you, and we thank you from the bottom of our hearts. It helps grow our future. And that's what we're here to do. So again, please shop locally. Always remember that. Please check out these festivals and all of them that are all over the region. I know that Prescott Valley, you just had your events. We all got events coming on. They bring tourists here. That creates this economy. So thank you all. Have a great day. Go create commerce.